How American airports are secretly becoming banks. Airports are known for their bustling terminals, duty-free shopping, and frequent delays, but did you know they are also quietly transforming into banks? Yes, you heard that right. American airports are increasingly investing their revenue into financial activities, from issuing bonds to making loans and operating like financial institutions. Let's explore how airports are expanding their financial activities and the controversies surrounding this trend. In recent years, they have become economic powerhouses, generating billions of dollars in revenue annually. So how do airports make money? Well, there are a few ways. First, airports charge airlines landing fees, which can be substantial. Additionally, they earn revenue from parking fees, retail and dining concessions, and rental car companies. But perhaps the most significant source of income for airports is the fees they charge passengers, such as security fees and facility charges. These fees may seem small, but they add up quickly and can account for a significant portion of an airport's revenue. Over time, airport revenue has grown substantially, with some airports earning as much as $1 billion annually. This increase can be attributed to several factors, including a rise in air travel, the expansion of airport facilities, and the increased use of technology to streamline operations. As airports have become more profitable, they have also become more attractive to investors. In recent years, airports have started to issue bonds to fund their expansion and maintenance projects. These bonds, known as airport revenue bonds, are backed by the revenue generated by the airport, and they allow airports to access capital at a lower cost than traditional bank loans. The rise of airport revenue and the increasing use of airport revenue bonds have transformed airports into significant players in the financial world. Today, many airports operate like financial institutions, investing their funds and issuing loans to other entities. This trend has led some to question whether airports are straying too far from their primary mission of serving air travelers. Nonetheless, the financial activities of airports are a fascinating and complex topic that warrants further exploration. And the transformation of American airports into something resembling banks has been a gradual process, spurred by the financial realities of airline frequent flyer programs. These programs have become increasingly important to the profitability of airlines, as they provide a significant source of revenue and help to drive customer loyalty. The evolution of frequent flyer programs began with the loyalty punch card, which evolved into formal frequent flyer programs after the deregulation of the American airline industry in 1978. These programs incentivize customers to fly with a particular airline by offering them the opportunity to accumulate points that can be redeemed for free flights. Studies have shown that customers are willing to pay slightly more to fly with a particular airline if it means they will get closer to earning a free flight. To manage the costs associated with these programs, airlines have developed complex financial models that allow them to maximize profitability. For example, they may charge higher redemption rates for certain flights or restrict the availability of free flights during peak travel times. They may also partner with credit card companies, allowing customers to earn miles for everyday purchases. The true innovation of frequent flyer programs was their ability to partner with other companies, allowing customers to earn points when renting cars or booking cruises. However, airlines couldn't simply give away miles for free without incurring costs themselves. While variable costs like food, fuel, and insurance are small, the redemption of miles is an expense that airlines must account for. Despite these costs, the loyalty programs of airlines have become an integral part of their business models. While airlines still transport passengers, they have evolved into something much more complex. In essence, they have become banks that offer free flights as a way to entice customers to fly with them. This shift has had a significant impact on airports as well. Airports have become increasingly reliant on non-aeronautical revenue streams such as retail, dining, and parking to make up for declining revenue from airline fees. Non-aeronautical revenue now accounts for approximately 40% of the total revenue for the average airport in the United States. This shift towards non-aeronautical revenue streams has led to a transformation of airports into something resembling shopping malls. Many airports now feature high-end shops and restaurants, as well as amenities like spas, gyms, and even movie theaters. This transformation has been driven by the desire to attract and retain high-spending customers, particularly those who are members of frequent flyer programs. While the transformation of American airports into banks may be concerning for some, it is ultimately a reflection of the changing nature of the aviation industry. As airlines continue to evolve and adapt to new challenges and opportunities, their loyalty programs will likely remain a key component of their business models. However, there are also potential downsides to frequent flyer programs, such as their contribution to overcapacity in the airline industry and their negative environmental impacts. One potential solution to these issues is for airlines to explore new ways to monetize their loyalty programs. For example, they could sell miles to banks and other partners, generating additional revenue and reducing their reliance on traditional airline operations. Additionally, airlines could invest in renewable energy or purchase carbon offsets to offset the environmental impact of their loyalty programs. Despite these potential downsides, frequent flyer programs remain an incredibly powerful tool for airlines to drive customer loyalty and generate revenue. As airlines continue to adapt and evolve, these programs will likely continue to play a central role in their business models. However, it is important for both airlines and consumers to be aware of the potential downsides of these programs and to work together to find solutions that benefit everyone involved. Now the question arises, what does the future hold? With increasing scrutiny from regulators and the public, airport financial activities may face greater regulation and oversight. This could include stricter disclosure requirements, increased transparency, and more rigorous risk management practices. Some experts predict that airports may even face limitations on the types of financial activities they can engage in. However, airports are not ones to sit idle and wait for changes to happen. They may adapt to the evolving financial landscape by exploring new revenue streams and innovative financing models. For instance, some airports are experimenting with new technologies such as blockchain to streamline their financial operations and increase efficiency. Others are exploring new forms of financing such as green bonds, which allow airports to raise funds for environmentally sustainable projects. Moreover, as the financial industry continues to evolve, airports may need to adapt to stay competitive. As mobile payments become more common, airports may need to invest in mobile payment infrastructure to accommodate changing consumer preferences. Additionally, airports may need to expand their financial services beyond traditional banking activities, such as offering investment advice or insurance products to travelers. Overall, the future of airport financial activities is uncertain, but one thing is clear. Airports will need to adapt to stay relevant and competitive. Whether through regulatory compliance, technological innovation, or new revenue streams, airports are likely to remain important players in the financial world. What are your thoughts on this? Let us know in the comment section below. If you enjoyed the video, be sure to like and subscribe to our channel so you don't miss any future videos. And share your thoughts in the comment section below. Thanks for watching.